Hello and welcome to another session of the My Solo 401k Financial uh, weekly YouTube webinar series. So thank you so much for attending. So we're about to get started. Hopefully you can hear me. If you're on YouTube or any of the other platforms, you'll have the ability to ask questions. So please feel free to chat over questions. We've got a fair number of slides to go through. So the plan is to go through the slides first, and then we'll start to turn to the questions. So today's topic is a great topic. It's regarding the 2023 and 2024 solo 401k contributions. It's really a deep dive guide, and it's focused on number one, businesses that are taxed as an S-Corp or a C-Corp, or it could be an LLC taxed as an S-Corp or a C-Corp, and specifically on making what are called mega backdoor Roth solo 401k contributions, because that's one of the top reasons that clients are signing up with us. So the presentation is being provided for educational purposes only. It should not be construed as tax, legal, or investment advice, nor as a solicitation. When making an investment decision, please consult with your tax attorney and financial professional. So first off, we want to just highlight that we've got a lot more great content coming up. So please subscribe to our YouTube channel so you can get notifications, you get access to all the recordings. So for example, we're going to continue on our discussion of these deep dive contribution guides focused on sole proprietors, single member LLCs, partnerships or multi-member LLCs. We'll also be having different mega backdoor Roth variations. Like today, we've got the mega backdoor Roth version of the S-Corp slash C-Corp category. So businesses that are taxed as an S-Corp or a C-Corp is specifically, again, focused on making mega backdoor Roth contributions. Also coming up on the schedule is going to be how much income do I need to be able to maximize contributions? So really trying to come up with that magic number of how much income you would need to be able to maximize, whether it's pre-tax or Roth or mega backdoor Roth, for all the different variations. So we'll really try to custom tailor different sessions to the different types of how the self-employed businesses are taxed. So as far as today's schedule, we're going to focus on really A to Z, all you would need to know for being able to make mega backdoor Roth solo 401k contributions for a business taxed as an S Corp or a C Corp, really for 2023 and 2024. We're going to focus on the contribution limits. We're then going to apply what we've learned on those contribution limits to different scenarios and examples. We'll highlight the resources like our online calculator. We'll talk about all the mechanics, right? So the deadline, how to make contributions, how to report contributions. And since this is geared towards a mega backdoor Roth scenario, we also want to spend some time talking about how to convert those voluntary after-tax contributions to either a Roth solo 401k or Roth IRA. And then lastly, we've got some bonus content, which is around the $1,500 solo 401k tax credit. So how that works, because we've got a lot of questions about that as well. So let's first start off with, at a high level, just what is the mega backdoor Roth solo 401k? What are the benefits? And in simple terms, it's really just a way to be able to contribute more to your solo 401k, where those funds end up in a Roth solo 401k. So for those who have a plan like ours that allows for mega backdoor Roth contributions and the income to justify those contributions, they can contribute as much as $66,000 or even $73,500 if 50 or older for 2023. And then, as you'll see when we talk about the limits for 2024, as much as $69,000 or even $76,500 if age 50 or older. Again, where those funds end up in your Roth solo 401k, which, as we, like any Roth account, right, you've got the potential for tax-free growth. So that's really the motivation. So you need a plan like ours that allows for making mega backdoor Roth solo 401k contributions. So you need to have a provider that offers plan that allows for voluntary after-tax contributions and then in-service distributions. So either converting the funds from either the voluntary after-tax solo 401k sub-account to the Roth solo 401k, or transferring the funds out of the voluntary after-tax solo 401k sub-account to a Roth IRA, and then just has the experience. It could help with all of the technical requirements, like having separate sub-accounts, as well as the required tax reporting. Because regardless of whether the funds are going to either a Roth solo 401k or whether those after-tax solo 401k funds are going to a Roth IRA, there is going to be a 1099-R that has to be prepared and filed to report that, which we handle that required 1099-R reporting as part of our service for no additional charge. And then, of course, like with any solo 401k, where you have to be eligible to set up a plan. So that means that you are self-employed with no full-time, non-owner, non-spouse W-2 employees working for any business owned by you or a spouse, if any. So of course, with an S-Corp or a C-Corp, you're going to receive a W-2, but that's fine. We're talking about non-owner W-2 employees or non-spouse W-2 employees. So anytime we talk about how much you can contribute to a plan, it's always good to remember that one's ability to contribute to the plan depends on different factors, right? One factor is going to be your income. You can't save more than you earn. Another factor is your age. As we've already started to see with some of the limits, once you're age 50 or older, you're eligible to make additional what they call catch-up contributions. Do you participate in another plan, like a day job plan? If yes, we'll see how that impacts your ability to make employee contributions. And then the type of contribution that you're looking to make, whether it's employee, employer, or voluntary after tax. All right, so the first factor there was your self-employment income. So what that means depends on, and how you determine your self-employment income depends on how your self-employed business is taxed, right? That's what we talked about. We got these other webinars coming up for different types of businesses, whether it's a sole prop or partnership. And if you subscribe, you get notifications to all the different webinars. But for a self-employed business that is taxed as an S-Corp or a C-Corp, could be a corporation taxed as an S-Corp or a C-Corp, could be an LLC that elects to be taxed as an S-Corp or a C-Corp. The ability to make solo 401k contributions is going to depend on the W-2 wages that you receive from the S-Corp or a C-Corp. So you can't consider wages from your day job if you happen to have a day job. You also can't receive the income that you receive as an owner of the S-Corp, like a K-1. So it's got to be based on that earned income, those W-2 wages. So not based on passive income, right? If you have passive income, say from a rental real estate property that you own personally, you wouldn't be able to use that passive income to be able to justify solo 401k contributions, because the whole purpose of any 401k is for someone who works, who has earned income, to be able to save for retirement. So that then, begs the question, well, what do we mean specifically when we say W-2 wages? So you start with box 1 of the W-2, plus any pre-tax elected deferrals not in box 1 that are instead reported in box 12. So for example, if you have $100,000 of wages that you earn from your self-employed business, let's assume you're over 50, let's assume that you had set up the plan before the end of 2023, and you made a $30,000 employee contribution. Your box 1, and you made that on a pre-tax basis. So now your box 1 is not 100,000, it's 70,000. Those $30,000 of employee contributions are over in box 12. So you would add box 1, 70, plus 30 in box 12 for a total of 100,000. And therefore, when you're determining how much you can contribute, say as an employer, which is 25% of the W-2 wages, it would be $25,000 or 25% of box 1 plus those pre-tax elected deferrals of $30,000 that are not in box 1 and been instead over in box 12. So now let's start to look at the different contribution limits. So there's the overall limit that applies to all types of contributions, the sum of all types of contributions that are made to the solo 401k. And then as you'll see as we go through it, there's different limits that apply based on the different type of contribution that you're looking to make. So for 2023, the overall limit is $66,000 plus an additional $7,500 if you're 50 or older. So oftentimes the limits get raised, right, based on inflation. So for 2024, the overall limit increased to $69,000, and that catch-up amount stayed the same of $7,500. So if you're 50 or older, that's how you could get up to $76,500 for 2024. So now let's look at the different contribution types, right? Start to dig in, zoom in a little bit more. So you have, when you're self-employed and therefore eligible to set up a solo 401k, you don't have any non-owner, non-spouse employees, you can make both employee and employer contributions to the solo 401k. That's why the solo 401k has the highest contribution limit for any defined contribution plan available to self-employed individuals. So that employee contribution, that could be made as pre-tax, Roth, or if you have a plan like ours that allows for it, voluntary after tax, which is how one ends up being able to make the mega backdoor Roth contributions. Now, pre-tax and Roth, as you'll see when we go to the next page, they have their own limit, whereas voluntary after tax is actually comes from a different section of the code. So it's the overall limit. That's why it's a higher limit. Now, the ability to make pre-tax and Roth employee contributions is impacted by contributions that are made to another plan, like a day job 401k plan. And that's because that employee limit applies at the employee level. So if you max out your employee contributions to another plan, like a day job plan, that individual would not be able to make any more employee contributions to the solo 401k. Whereas with employer contributions, that limit applies at the plan level, at the employer level. So it's not impacted by contributions that you make to a day job plan. It's not impacted by contributions that are made on your behalf to your day job plan, like a matching contribution. The one exception to that would be a 403b. So with a 403b, all contributions that are made to the 403b, whether they're employee, employer, along with any contributions that you would want to make to the solo 401k, are aggregated and the sum cannot exceed the overall limit. But the general rule though with employer contributions is you don't consider not affected by contributions to a day job plan. Now, those employer contributions historically were always made as pre-tax contributions. With Secure Act 2.0, now those contributions can be made as Roth contributions. So you could have Roth employee, you could have Roth employer. Now, the catch-up contribution, right, the $7,500, let's moving down to the second half of the slide here, the bottom half, the $7,500 that you can make if you're 50 or older. So that is a type of employee that can be made as either a pre-tax or a Roth. It cannot be made as an after-tax. So if you're making that $7,500 contribution, it's either got to go into your pre-tax or your Roth bucket. Again, now with the Secure Act 2.0, employer contributions can be made as Roth contributions. We'll talk a little bit more about the details of that here in a few slides. And then finally, voluntary after tax. This is part of it's considered to be an employee contribution, but the limit comes from a different section of the code. So it's actually the overall limit, which is higher than your employee limit. This is how you're able to make additional contributions above and beyond. And those contributions can then be moved over to the Roth Solo 401k sub account, which is where you get the backdoor Roth nomenclature, right? Because it's similar to a backdoor Roth IRA, where you're first contributing it to the after-tax account before it gets moved over to either the Roth Solo 401k or the Roth IRA. Again, the catch-up contribution cannot be made as an after-tax. And then the last bullet here is that voluntary after-tax contributions, even though they are a type of employee contribution, because the limit comes from a different section of the code, which applies at the plan level, it's not impacted by contributions made to another plan like a day job plan, unless we're talking about a 403b, right? Because you always got that 403b exception in the background. which may or may not apply to you, right? Depends on whether you are making contributions to a 403b. So now let's continue to zoom in, right? So now let's really look at these limits, right? So you got the overall limit, and then you got to consider, okay, what type of contribution am I making? So if it's going to be an employee contribution, a salary deferral, right? Here, the limit is 100% of the W-2 wages from your self-employed business taxed as an S or a C, up to 22,500 for 2023, plus an additional $7,500 if you're 50 or older. For 2024, that limit increased to $23,000, or again, an additional $7,500 if you're 50 or older. This contribution can be made as a pre-tax contribution, or it can be made as a Roth contribution. Again, that employee limit applies at the employee level, so you would need to reduce how much you can contribute as an employee contribution to the solo 401k by any contributions made to another plan, like that day job 401k plan, unless the other plan is a 457 governmental plan, in which the contributions are not aggregated. Okay, so this slide just highlights that you can make this employee contribution as a Roth contribution. Could be a mixture of pre-tax and Roth. It could be just one or the other. If you're going to be making those Roth employee contributions, those contributions need to go into a separate sub-account. So you'd have, say, one account in the name of the plan for pre-tax dollars, a second for Roth. Okay, so now let's shift and talk about the employer contribution. So this is also referred to as a profit-sharing contribution. For a self-employed business that is taxed as an S or a C, your ability to contribute to the plan is always based on your W-2 wages that you receive from your self-employed business taxed as an S-Corp or a C-Corp. And then it's going to be 25% of those wages. Again, remember, you take box 1 of the W-2 plus any pre-tax elected deferrals not in box 1, but instead reported in box 12. And then it's 25% of that amount. Keeping in mind the overall limit, right? So the aggregate contributions that are made to the solo 401k, so the combination of employee, employer, after tax, can't exceed the overall limit, right? 66,000 for 2023, 69,000 for 2024, plus an additional $7,500 if you're 50 or older. Unlike the employee contributions, where you have to consider contributions made to the day job 401k plan, your ability to make employer contributions to your solo 401k is not impacted by contributions made to another retirement plan through an unrelated employer. So for example, the day job 401k plan, unless those contributions were made to a 403b, in which case you'd have to consider all the contributions made to the 403b plus the contributions that you want to make to the solo 401k, and the sum cannot exceed the overall limit. So Secure Act 2.0 now allows these employer, non-elective, profit sharing, right? These are all synonyms, to be made as Roth contributions. Now, for plans like ours that allow for mega backdoor Roth contributions, typically most found there was no good reason really to make, no compelling reason to make the employer contributions as Roth contributions. So why might that be? Well, if you have a plan that allows for voluntary after-tax contributions, and your objective is to have these funds in a Roth solo 401k, you don't need as much income to be able to justify the contribution that you want to make, right? Because as we just saw, the employer contribution limit is a percentage of your self-employment compensation, the W-2 wages, in the case of a self-employed business taxed as an S-Corp or a C-Corp, right? It's 25%. Whereas, as we'll see when we talk about the voluntary after-tax contribution limit, you can contribute 100% of your wages, dollar for dollar, up to the overall limit. So you don't need as much W-2 wages to be able to hit your contribution objective within the limits, of course. There's no difference between making, in terms of the deadline to make contributions, between the voluntary after-tax contributions or employer contributions. So in either case, the plan would just need to be established in time to make the contributions by the business tax return deadline, including any timely filed extension. So yes, that means if you haven't even set up a plan before the end of 2023, you could still set up a plan in 2024 and make 2023 contributions, whether it's employer or after tax, as long as the plan is set up and the contributions are made by the business tax return deadline, including any timely filed extension. And then lastly, why would someone who has a plan that allows for the voluntary after-tax contributions, why would they often not make the contributions as the employer contributions as Roth contributions? Last point is because when you're talking about making voluntary after-tax contributions, you have more flexibility with those funds, right? So typically, the standard rule is that you can't transfer funds out of the solo 401k, even if they're going to another retirement account, until you've met a triggering event. So typically that means you're age 59 and a half or greater. One exception to that standard rule, though, are voluntary after-tax contributions. So you don't need to meet a triggering event before you could transfer those voluntary after-tax contributions out of the solo 401k, say to a Roth IRA. So that's another reason why many would choose to make the contributions as after tax instead of making employer contributions as Roth. Because if one is making a Roth employer contribution as a Roth contribution, you'd have to meet a triggering event before the funds could be transferred out of the plan to a Roth IRA. But let's assume you still want to make those employer contributions as Roth contributions. So here's some frequently asked questions. Do I need to deposit those employer contributions made as Roth solo 401k contributions in a separate account? Yes, they need to go into a separate Roth solo 401k account, but it could be the same Roth solo 401k account that you might be making in Roth employee contributions to. What is the contribution limit for employer solo 401k contributions made as Roth solo 401k contributions? Well, it's the same limit that applies to employer contributions generally, 25% of the self-employment compensation. In other words, the W-2 wages that you receive from your self-employed business that is taxed as an S-Corp or a C-Corp. Lastly, how do I report employer solo 401k contributions made as Roth solo 401k contributions? Well, per IRS Notice 2024-2, Roth employer contributions are reported as tax deductible on the employer's tax return for the year for which the contributions are made, right? So back to the scenario where someone is making 2023 employer contributions during the 2024 calendar year. So as long as the contributions are made by the business tax return deadline, they can be made for 2023. So in that case, even if they're made as a Roth employer contribution, which ultimately is going to be after tax, on the employer's tax return, it's tax deductible. So it reduces the 2023 income of the employer, but then it's reported as taxable to the employee for the year for which the contributions are deposited. So it's taxable to the employee for 2024. And the way that that's reported as taxable is by issuing a 2024 1099-R. So it's akin to as if someone had made a pre-tax employer contribution for 2023, but then immediately moved the funds over like an in-plan conversion from their pre-tax solo 401k sub-account to the Roth solo 401k sub-account. So it's akin to that from a reporting perspective. Now, you literally don't have to put the funds into the pre-tax solo 401k sub-account and then move them to the Roth solo 401k sub-account. You can deposit them directly to the Roth solo 401k. But from a reporting perspective, it's going to be akin to that because you're going to reduce that. It's going to be tax deductible on the employer's return for the year of the contribution, for the year for which it was made, 2023 in our example, but taxable to the employee for the year of the deposit. Okay, so now let's talk about the after-tax solo 401k contribution limit. Voluntary after-tax solo 401k contributions are how one makes mega backdoor Roth contributions. The limit is higher than that Roth employee limit, right? Remember the Roth employee limit, 22.5 for 2023, 23,000 for 2024, plus an additional $7,500 if 50 or older. Well, the voluntary after-tax contribution limit is higher. It's 100%. of the W-2 wages, dollar for dollar, up to the overall limit. In other words, it's the lesser of your self-employment compensation or the overall limit. But keeping in mind, of course, that you've got that overall limit. So you'd have to reduce how much you can contribute to the solo 401k as a voluntary after-tax contribution by any employee or employer contributions made to the plan. Now, you don't have to reduce it by the $7,500 voluntary after-tax, $7,500 catch-up contribution. So you don't reduce how much you can contribute as a voluntary after-tax contribution by the catch-up contribution if you're 50 or older, but the voluntary after-tax limit doesn't go up if you're 50 or older. So you still end up in the same place and being able to hit, for example, 76,500 for 2024 if you got the self-employment compensation to justify it. It's just that the $7,500 catch-up contribution wouldn't be made as an after-tax contribution. It'd either go into the pre-tax solo 401k sub-account or the Roth solo 401k sub-account. Now, remember we talked about how the reason that this is a higher limit is because it comes from a different section of the code. So that means that this voluntary after-tax solo 401k contribution limit, even though it's a type of employee contribution, it's not impacted by other contributions that are made by the employee to another retirement plan through an unrelated employer, like the day job 401k plan, unless the other plan is a 403b plan. But like the Roth employee contributions, these voluntary after-tax solo 401k contributions need to be deposited into a separate voluntary after-tax solo 401k sub-account. This is how one ends up with multiple sub-accounts, right? Pre-tax, Roth, and voluntary after-tax. So now that we've gone through the rules, let's apply it to different scenarios to illustrate how it works. So we're going to start with a self-employed business taxed as an S corporation, one participant, under 50 years of age, doesn't make contributions to another plan like a day job plan. Their goal is to first maximize the pre-tax contributions to reduce their taxable income, and then make any additional contributions as Roth and or voluntary after-tax contributions. We're going to assume for purposes of the employer contributions that these are only going to be made as pre-tax contributions. And then lastly, we're going to assume that they have $100,000 of W-2 wages. So this is our baseline scenario. And then you'll see that we're going to tweak the different variables to illustrate different points. So in the baseline scenario, this individual is going to be able to contribute 100% of their wages, up to $22,000 for 2023, as a pre-tax employee. For 2024, they'll be able to contribute up to $23,000 as a pre-tax employee. They'd be able to contribute 25% of their W-2 wages as an employer contribution, also into that same pre-tax account. And then they're going to be able to contribute the difference as up to the overall limit, right? $66,000 for 2023, $69,000 for 2024 as a voluntary after-tax contribution. And then those voluntary after-tax funds can be moved from the voluntary after-tax solo 401k sub-account to the Roth solo 401k sub-account. So at the end of the day, for 2023, this individual would have $47,500 in their pre-tax solo 401k sub-account for 2023, and $18,500 in their Roth solo 401k sub-account for 2023. For 2024, they're going to have $48,000 in their pre-tax solo 401k sub-account, and then $21,000 in their Roth solo 401k sub-account after they made that after-tax solo 401k contribution, which was then moved over to their Roth solo 401k. So now let's change one of the variables in our base scenario. So instead of $100,000 of W-2 wages, let's assume $50,000. So how does this impact how much this individual can contribute to the solo 401k? What makes no difference, it doesn't impact their ability to make pre-tax employee contributions. It does impact how much they can contribute as a pre-tax employer contribution, because remember, it's 25% of their self-employment compensation, meaning their wages. So since we reduced that from 100,000 to 50,000, now they can only contribute $12,500 as a pre-tax employer contribution. And then they're going to be able to contribute the difference up to $50,000. So this is a good illustration of how your ability to contribute to the plan, you cannot save more than you earn, right? So you can't contribute more than $50,000 in this scenario. So you'd be able to contribute the difference up to 50,000. So that's a $15,000 as an after tax for 2023, $14,500 as an after tax for 2024. So now let's go back to the base of $100,000 of W-2 wages. But now let's assume that this individual is maxing out their employee contributions to a day job plan. So that means they're not going to be able to make any employee contributions to the solo 401k, right? Because that employee limit, remember, this illustrates how that employee limit applies at the employee level. But it's not going to impact their ability to make employer or after-tax contributions. They also don't have to aggregate those contributions made to the day job plan when figuring out whether they've met the overall limit. So in terms of the employer contribution amount, it's going to be the same as the baseline scenario, 25% of the W-2 wages. This person wasn't able to make any employee contributions to the plan, but they can still go up to the overall limit with their after-tax contribution. So that's another 41,000 as a voluntary after-tax for 2023, or 44,000 as a voluntary after-tax for 2024, which then they can move over to their Roth solo 401k. So at the end of the day, for 2023, they'd have $25,000 in their pre-tax solo 401k sub-account, $41,000 in their Roth solo 401k sub-account. For 2024, $25,000 in their pre-tax solo 401k sub-account, $44,000 in their Roth solo 401k sub-account. So now let's go to another scenario. Back to the base. This person doesn't make contributions to another plan. Here, they're not interested in making pre-tax solo 401k contributions, only interested in making those Roth or voluntary after-tax. So instead of making that employee contribution as a pre-tax contribution, they're going to make it all as a Roth contribution. We're assuming that it's the same amount, right? It's just going out into their Roth solo 401k. We assumed, right, that their employer contributions would only be made as pre-tax. So they're not going to be making any pre-tax employer contributions because they're not interested in making pre-tax contributions. So now they're just going to make the difference up to the overall limit as a voluntary after-tax, $43,500 for 2023, $46,000 because the limit went up for 2024. So at the end of the day, they're going to have $66,000 in their Roth solo 401k for 2023, $69,000 in their Roth solo 401k for 2024. So now let's go back to the base. Doesn't make any contributions to another plan. They first want to maximize pre-tax and then make any additional contributions that they can make as Roth and or voluntary after-tax. But now let's assume that there are two participants, right? It could be a husband and wife that are both working in the same business, etc. Each person is making $100,000 of W-2 wages from the self-employed business. So the amounts that can be contributed doesn't change from the base. Really, this just illustrates that the limit applies for each person. And since each person has the same profile from a contribution perspective, right? Same wage, same age, same objective, doesn't make contributions to another plan, each person would be able to contribute the same amounts. Now, it's a good also illustration that there would really be 3 separate accounts for each person for a total of 6 accounts, right? A pre-tax and a Roth, as well as a third after-tax for each. So now let's go back to the base. One person doesn't make contributions to another plan, first wants to do pre-tax, then Roth or after-tax, $100,000 of W-2 wages. But what's changing here is now they're 50 or older. So what changes with our contribution limits? Well, they're still going to be able to make the $22,500 for 2023 as an employee pre-tax, or $23,000 as an employee pre-tax for 2024. But now they're also going to be able to make an additional $7,500 catch-up, right? So that's the first point we want to illustrate. The second point we want to illustrate is that their voluntary after-tax amount doesn't change, right? Because remember, the rule is that you can contribute 100% of the W-2 wages, the self-employment compensation, up to the overall limit, right? 66,000 for 2023, 69,000 for 2024, reduced by other contributions that are made to the plan. So the employee plus the employer, but you don't reduce it, you ignore the catch-up contribution. So that puts you in the same place as the person who was under 50 in terms of how much they can contribute as an after tax. So it illustrates that point of the calculation. It also illustrates that the limit doesn't go up. So if you're going to make that catch-up contribution, it's not made as an after-tax contribution. It's made either as a pre-tax employee, like in this case, or a Roth employee, if the person's objective was making Roth contributions. So now let's go back to the base. Here, this person is maxing out contributions to a day job plan, but they're not interested in making pre-tax contributions to the solo 401k. So here, they're not going to be able to make any employee contributions because they've already hit their max under their day job plan. They're not interested in making pre-tax employer. So this person could just make all their contributions to the solo 401k as a voluntary after tax, $66,000 for 2023, $69,000 for 2024. So now let's go back to the base. We're similar scenario, but this person is now 50 or older, but they're still maxing out contributions to their day job plan. So they're making 30,000 for 2023, 30,500 for 2024, because they're making the $7,500 catch up to the day job plan. They're still not going to be able to make any employee contributions to the solo 401k. They still don't want to make any pre-tax employer, and they still make 100% as an after-tax contribution to the solo 401k, 66,000 for 2023, 69,000 for 2024. So now let's go back to the base. And so this scenario, though, the changes are we got two participants. Each person is maxing out to their day job plan. Each person is only interested in making Roth or after tax. Each person has $100,000 of W-2 wages. So similar takeaway here, right, is that the limits apply based on each person's scenario. Since we're assuming that each person has the same profile, right, same age, same self-employment income, same objective of only making Roth or after tax, that each person is going to be making the same amount of contributions, just going to their own separate accounts. So let's highlight a good resource, how to use our online calculator. So if you go to our website, mysolo401k.net, there's a menu that goes left to right, home, about, solo 401k. If you go to the right, you see that there's a drop down under learn, and then click on online tools. From there, you'll be able to access our calculator. Now, for a self-employed business that is taxed as an S-Corp or a C-Corp, for business type, you're going to choose corporation. You're going to enter the W-2 wages. Remember, that's box 1 of the W-2, plus any pre-tax elected deferrals not in box 1, but over in box 12. Now, the calculator doesn't accommodate for scenarios where you're making contributions to another plan like a day job. It doesn't accommodate for the after-tax scenario, so you'd have to modify based on that. But it's a great tool and a good starting point for sure, at least. How do I make contributions? So now let's talk about the mechanics of making contributions. So of course you can make these contributions by check, for example, write annual contribution in the memo section of the check. From a solo 401k perspective, it would certainly be acceptable to make the contributions by electronic transfer. Now, we are helping our clients set up accounts at hundreds of different banks, many different brokerages. So the rules for making an electronic deposit to your specific account is going to depend on the financial institution that holds the account, right? It could be a bank, a credit union, a brokerage like Fidelity or Schwab. So many clients want to have a brokerage account for their solo 401k, and we're very hands-on. We pre-fill the paperwork to help open up the account. It's noteworthy that the typical brokerage, most brokerages don't allow an electronic deposit from an external account where the name on the external account doesn't match the name on the account at the brokerage, right? So the name on the account at the brokerage is going to be the name of your solo 401k. if you're trying to make an electronic deposit from a personal account or a business account. Typically, the brokerages would not allow for that. Now, the one exception would be Fidelity. They do allow for electronic deposits from an external account. Of course, with the other brokerages, there's easy workarounds, right? You could transfer the money to a non-retirement account at the same brokerage and then move the money from the non-retirement brokerage account at the same brokerage to the brokerage account that was opened up for your solo 401k. Other things that are, again, good to highlight is that if there are multiple participants in the solo 401k, like the husband and wife scenario, each person's going to have their own separate sub account. If you have different types of contributions, right? Pre-tax, Roth, after tax, there's different sub accounts for each of those different types. What is the deadline to make solo 401k contributions? Well, per IRS publication 560, for all types of solo 401k contributions, the contribution deadline is the business tax return deadline, including any timely filed extension. Now, for employee contributions, the plan needs to be set up by the end of the year, right? So for those employee contributions, if you want to make 2023 contributions and you set up the plan, for example, you signed up with us before the end of December 31st, 2023, you'll be able to make those contributions by the business tax return deadline, including any timely filed extension. For other types of contributions, like employer, like after tax, it would be possible to set up the plan now after the end of 2023 and still make those 2023 employer or after tax contributions, as long as the plan was set up and the contributions were made by the business tax return deadline, including any timely filed extension. So that, now we come to these good charts that just show us those different contribution deadlines, right? So you can see that it's driven by how the self-employed business is taxed. So for an S-Corp, it's March 15th or September 16th of 2024 for purposes of 2023 contributions. For a C-Corp, it's April 15th or October 15th if you file a timely extension of this year for making those 2023 contributions. For purposes of making 2024 contributions, the deadline is going to be, again, the business tax return deadline, including any timely filed extension. So that's March 17th of 2025 or September 15th of 2025 if you file a timely extension for your S-Corp business. If your self-employed business is taxed as a C-Corp for 2024, it's going to be April 15th of 2025 or October 15th if you file a timely extension. And this all makes sense from a policy perspective, right? Why they would have these later deadlines for a self-employed person per, again, IRS publication 560, which is the landmark guidance for self-employed retirement plans like a solo 401k. And because many self-employed individuals don't know how much they've made until after the end of the year. This is why it's different than the contribution deadline for a full-time employer plan, right? Like one that you might have at your day job, where you got to make that contribution by the end of the year. For self-employed people, right? Remember, we started out with saying that your ability to contribute to the plan is based on different factors, starting with your self-employment compensation, because you can't save more than you earn. Well, many self-employed people don't know exactly what their self-employment compensation is until after the end of the year. So that's why you have that additional time. That's why it makes sense that self-employed people would have more time to determine how much they can contribute. So how do I report contributions? Well, it depends on what contribution type you're referring to. So if it's an employee contribution and it's a pre-tax employee contribution, it would not be reported in box 1 of the W-2, but instead reported in box 12. And then you check the retirement plan field in box 13. If it's a Roth employee contribution, you're not going to reduce box 1 of your W-2, right? Because it's not reducing your taxable income, but it's still reported on the W-2 in box 12 using code AA, and you check the retirement plan field in box 13. If it's a voluntary after-tax contribution, remember that's an employee contribution, it's optional to report it on the W-2. Of course, it's not going to reduce box one. It's not going to reduce your taxable income because it's after tax. You may report it on the W-2, but it's optional per those W-2 instructions. If you choose to report it on the W-2, per those W-2 instructions, it would be reported over in box 14. So now let's talk about, how do I report employer contributions? Well, it depends on the type of contribution that we're referring to and how your business is taxed. So if your business is taxed as an S-Corp, it would be reported on line 17 of the Form 1120S. If your business is taxed as a C-Corp, it would be reported on line 23 of the Form 1120S. And that's, again, for both pre-tax and Roth employer contributions. Remember, per the recent IRS Notice 2024-2, where they've clarified how to report employer Roth contributions, which became allowable under Secure Act 2.0, those contributions are reported as tax deductible for the year for which the contributions are being made on the employer's tax return. So this means the S-Corp tax return for a business tax as an S corporation, or the C-Corp tax return for a business tax as a C corporation. But then it's reported as taxable for the year in which the contributions were deposited to the employee. So it reduces the employer's taxable income, but then raises the employee's taxable income. But it raises the employee's taxable income on the year, I should say, for the year of the deposit. So if that contribution is being made in 2024, but for 2023, it's going to be reported as taxable to the employee in 2024, the year of the deposit. And the way that that's reported is on a 1099-R that's issued to the employee for the year of the deposit. We just clarified that slide there on the fly. So hopefully that makes sense. How do I convert? So remember, here the focus is we want to spend some time focusing on the mega backdoor Roth solo 401k contribution scenario, because it's such a popular reason why clients are setting up accounts with us. And so we've learned now why individuals are making voluntary after-tax contributions is because the voluntary after-tax contribution is higher than the typical Roth employee contribution limit. That's how you're able to get up to the overall limit of $66,000 or $69,000 for 2024. And we've also talked about how under those mega backdoor Roth rules, the voluntary after-tax contribution needs to be deposited into a separate voluntary after-tax account. But if there are gains in that voluntary after-tax account, those gains will be taxable. But if those funds are moved from the voluntary after-tax account to either the Roth solo 401k, or they could even be moved out of the plan to a Roth IRA, then any subsequent gains would be tax deferred and potentially tax-free if at the time of the withdrawal, the individual is able to take a qualified Roth distribution. And so those funds, there's no triggering event that has to be met. And if you have a plan like ours that allows for those voluntary after-tax funds to either be converted to the Roth solo 401k or transferred out to a Roth IRA, then that can be done shortly after the contribution so that any subsequent gains have that potential to be tax-free. So the question becomes, how do I convert from the voluntary after-tax solo 401k sub-account to the Roth solo 401k sub-account? And the answer is that it can be done by check. It can be done electronically. All would be acceptable from a solo 401k perspective. Of course, you'd have to check with the financial institution that's providing the accounts to determine their specific electronic procedure. Can be transferred between banks, so from one bank account to another, from one brokerage account to another, even from a brokerage to a bank, etc. So let's keep discussing the mechanics. So we've got different brokerage firms to highlight just to illustrate the points. So here, one second. We want to basically just And we'll have the latest version of the slides available on our website. So please stay tuned so you get access to that. So let's assume that as part of the onboarding process, we help clients open up accounts at the bank or brokerage of choice. We ask you, where do you want to have the account at? If you say Schwab, we would prepare the paperwork to open up the requisite number of accounts at Schwab. We would ask, are you trying to make mega backdoor Roth contributions? If yes, we would pre-fill the paperwork to open up 3 different accounts at Schwab, or 6, right? If there's 2 participants. So once that voluntary after-tax solo 401k sub-account is opened up at Schwab, the individual would make the voluntary after-tax contribution, right, subject to all the good limits we talked about, and then those funds could be converted over to the Roth solo 401k sub-account at Schwab. Or it could go to a Roth IRA that the individual may already have at Schwab. So the funds would then be converted, right, from the after-tax to the Roth, either solo 401k, in-plan conversion, or transferred out to a Roth IRA. And then the clients would let us know about that transaction, about that conversion from the after-tax to the Roth solo 401k or a Roth IRA. We have forms on our website that clients can use 24/7 to provide us that information. That's how we gather the information that's needed to prepare the 1099-R, which we handle as part of our service for no additional charge. So even though, like we learned a few slides back, that making the contribution itself does not have to be reported. It's optional to report that in the W-2. But the subsequent transfer from the voluntary after-tax solo 401k sub-account to either the Roth solo 401k or Roth IRA, that does need to be reported on a 1099-R. And it's going to be a very similar process at Fidelity, right? If clients tell us, hey, I want to have the accounts of Fidelity, no problem. We pre-fill the paperwork that Fidelity requires to open the free brokerage accounts, right? Just like Schwab, they don't charge anything to set up the account. There's no maintenance fee. You've got to have this different sub accounts though, right? So we have deep experience in helping clients because many, many clients want to make these mega backdoor Roth contributions. So under the rules, those voluntary after-tax contributions need to go into a separate account before they get moved over to either the Roth solo 401k, or it could be a Roth IRA that the individual already has at Fidelity, or even another institution. And then step 3, they provide us the information that's needed so we can prepare the 1099-R. So that often prompts the question, should I convert to a Roth IRA or Roth solo 401k? So let's look at some of the differences between the 2 types of accounts. So a Roth IRA is not an employer plan, so distributions can be made at any time. Remember, we talked about how the standard rule is that you have to meet a triggering event before you can remove funds from an employer plan. One exception is voluntary after-tax contributions. That's why those funds can be transferred out right away without the need to meet a triggering event to, say, a Roth IRA. But that would be an attraction for some folks as far as the Roth IRA, moving the funds over to a Roth IRA, because you could, considering the Roth IRA distribution rules, the ordering rules, funds can be moved out, taken out at any time. Roth IRAs are not subject to required minimum distributions. So, which is now the same for Roth solo 401ks. So no RMDs apply to Roth solo 401k funds starting here in 2024. That was a Secure Act change. Participant loans are not permitted from IRAs. Well, that's a difference with the Roth solo 401k. So that would be a reason that clients would want to move the money from an after-tax solo 401k account to a Roth solo 401k sub-account, because they could still use those funds in the Roth solo 401k if they later want to take a 401k participant loan, say for some personal emergency, et cetera. So lastly, if someone is investing in real estate, which is a very common use case for our plan, and they want to use debt in conjunction with their retirement money, so it has to be a special kind of debt called non-recourse financing, regardless of whether they're making that real estate investment via their Roth IRA. Of course, it would have to be a self-directed Roth IRA that allows for real estate investing, or a Roth solo 401k, like our plan does, of course, allow for that type of investing. In either case, if they want to use their retirement money in conjunction with debt, it has to be a special kind of debt called non-recourse financing. But the difference is that if you have income inside your Roth IRA from debt financed investments like real estate, the income is going to be subject to a tax payable by the Roth IRA called unrelated debt finance income tax. Whereas there is an exception to that unrelated debt finance income tax with respect to income from a debt finance real estate investment inside your solo 401k. So that would be a reason for clients that are looking to make those types of investments that they would transfer the voluntary after-tax money to the Roth solo 401k as opposed to going to a Roth IRA. And then just more broadly speaking, just for alternative investments generally, even if they're not looking to make debt financed investments, that would be a reason that clients would keep the money in the plan, transfer the voluntary after-tax funds to a Roth solo 401k because they're looking to invest in real estate or crypto or private placements using those Roth solo 401k dollars. So hopefully that helps. So we've talked about the deadline to make contribution, right? It's that business tax return deadline, including any timely filed extension. So that's the deadline to deposit the money into the voluntary after-tax account. There's no deadline, though, to transfer the money from the voluntary after-tax account to either the Roth solo 401k or Roth IRA. Now, of course, we also talked about how that subsequent transfer from the after-tax solo 401k sub-account to either the Roth solo 401k or Roth IRA, that is reportable on a 1099-R. So that is going to be reportable for the year of the conversion. So someone might be making voluntary after-tax solo 401k contributions for 2023, but they make that deposit during the 2024 year and then transfer the funds to either the Roth solo 401k or Roth IRA during 2024. So that would be reported on a 2024 1099-R. And I think we might have issues with the audio here, so we're just gonna let's go back here. So just the point here is that we have forms on the website. The point is that the after-tax to Roth solo 401k or after-tax to Roth IRA is reportable on a 1099-R. We handle the 1099-R as part of our service for no additional charge. We don't have access to the account, so clients need to give us the information that's needed to be able to prepare that 1099-R. There's forms on our website that you can use 24/7. There may be gains that are part of the money that's transferred from the after-tax account to either the Roth solo 401k or Roth IRA. That would be separately reported on the 1099-R. In any case, it's going to be reported on your Form 1040. So you'd share that with your tax advisor so that they can report it correctly on your 1099, on your 1040. Excuse me. So just clean this reference up here. Thank you so much for your patience. Again, we're going to post the final version of the slides on the website, so please stay tuned. So now let's just look at some of the account setups, right? So we've talked about how these different types of contributions need to go into different sub-accounts. So in this picture, we've got one person
who has pre-tax, Roth, and after-tax funds. So now they've got 3 different sub-accounts. Each account is opened up under the name and the EIN number of the plan. We obtain an EIN number as part of the onboarding process. One account for the pre-tax, a second account for the Roth, a third account for the after-tax. Now let's look at a 2-participant scenario. That's how you end up with 6 accounts, pre-tax, Roth, and after-tax for each person. Now let's look at the scenario where the person wants to transfer the after-tax out of the plan to a Roth IRA. So in that case, they would only really need 2 accounts, right? If they have pre-tax money, they got the pre-tax account. They have to have that separate after-tax account for making those voluntary after-tax contributions, but then can be transferred out of the solo 401k to a Roth IRA. Okay, that takes us to the end of the content regarding the solo 401k contributions. So now let's talk about the tax credit. So our plan now qualifies for a $1,500 tax credit. So let's explore what that means exactly. So under the Secure Act, tax credits became available to small businesses to encourage those businesses to set up 401k plans, et cetera, to deal with the perceived retirement savings crisis. So a solo 401k plan that includes the auto participation feature, which all of our new plans going forward do, is eligible for a $1,500 tax credit. So that's going to be $500 per year for 3 consecutive years. If you're setting up a new plan, of course, it's automatically going to include the feature, so you'd be eligible to claim the credit. If you have an existing solo 401k somewhere else and you want to upgrade your plan to our plan, then now you'd be able to claim the credit, right? Like many people start out with the basic plan at a discount brokerage like Fidelity or Schwab that doesn't offer the mega backdoor Roth. Now they want to start making those mega backdoor Roth contributions. They would need to convert the plan to our plan in order to be able to make those contributions. Because remember, you have to have a plan that allows for the voluntary after-tax contributions as well as that in-plan transfer to either the Roth Solo 401k or Roth IRA. But now as part of that upgrade to be able to make the mega backdoor Roth contributions, now they would also be eligible for the credit, right? The $500 per year for up to 3 consecutive years. Now, there's other credits that were part of that Secure Act. For example, there's the startup cost credit. The startup cost credit is not available for solo 401k plans because in order to be able to claim a startup cost credit, you have to have non-owner employees participating in the plan. Of course, you can't set up a solo 401k if you have non-owner W-2 employees. But unlike the startup cost credit, which as the name implies, the amount of the credit is based on the costs, the auto participation credit is not based on the actual cost to set up and maintain the plan. So with a plan like ours that the costs are less than $1,500, that's okay. You would still be eligible to claim the full credit. So if someone sets up a new plan here in 2024, they'd be able to claim the $500 credit starting when they file their 2024 taxes, and then again for 2 more years for a total of 3 years, as long as they continue to maintain the plan with the auto participation feature. For 2025, if they set up the plan next year in 2025, they'll be able to claim the credit when they file their 2025 taxes, and then again for 2 more years for a total of $1,500. For someone that wants to upgrade their existing basic plan, like we talked about with the discount brokerage scenario, like a Fidelity or Schwab or a Vanguard plan, and then they convert their plan to our plan during 2024, now they're eligible to claim the credit when they file their 2024 taxes, $500 for 2024, and then again for 2 more years for a total of $1,500, as long as they maintain that plan with the auto participation feature. Whereas if someone converts their existing plan to our plan in 2025, they'd be able to start claiming the credit when they file their 2025 taxes. So we talked about how the ability to claim the credit is not a function of the costs. So for example, our fee is $650, which includes the $525 establishment fee, plus the first $125 annual fee. On the anniversary date, like say this time next year, if you were to sign up today, the $125 annual fee would be due to cover the second year. So you can see the tremendous impact on the cost. For the first year, the net cost after the credit is $150. But for the second and third years, the value of the credit actually exceeds the cost. So again, your ability to claim the credit is not a function of the cost. And this is a tax credit, not a tax deduction. So with a tax deduction, one is reducing their expenses by the amount of they're reducing their income by the amount of the expense. Whereas with a tax credit, you're reducing your tax liability by the amount of the credit. So it has you're reducing your tax liability dollar for dollar. So when you reduce your taxable income, that reduces how much tax you owe on that income. Whereas if you have a tax credit, you first determine your tax liability, and then you get to reduce that tax liability dollar for dollar. So in that way, it's much better and more valuable as far as reducing your ultimate tax liability. So in order to be eligible to claim the credit, first of all, you have to be eligible to set up a solo 401k, right? You're self-employed, reporting earned self-employment activity on your taxes, no full-time, non-owner, non-spouse W-2 employees working for any business owned by you or a spouse, if any. Then you set up a solo 401k plan like ours that has the auto contribution feature. What is the auto contribution feature? Well, the way that it works is it sets a default 3% contribution amount. But under the terms of that auto contribution feature, you, as the employee, have to be given the opportunity to opt out of the default amount. So opting out of the default amount is going to preserve all the flexibility that comes with making solo 401k contributions, for self-employed people, right? Like we talked about, you can make the contributions by the business tax return deadline, including any timely filed extension. You can make those contributions in a lump sum amount, or it could be every pay period, right? So you can make the contributions whichever interval, whichever amount, et cetera, subject, of course, to the limits and the deadlines. So by opting out of the default amount, you preserve all that flexibility. In other words, you're not even required to make annual solo 401k contributions to qualify for the credit. So exercising your right to opt out of the default amount doesn't mean you no longer have the credit. You do, and therefore you're still eligible to claim the credit. Yes, we talked about how if you can have an existing plan and then upgrade it to our plan to include the auto contribution feature and therefore be eligible to claim the credit. You claim the credit by filing Form 8881, which is really the first step in the process. We have a deep dive walkthrough that really walks through and lays out all the required steps. You'd be able to easily claim the credit, or you could share it with your tax advisor just to make it easy for you. And we would share that, we share that walkthrough and make it available to, of course, all of our clients so they can claim the credit. So Lindsay is self-employed. She already has a solo 401k, but she upgrades to our plan here in 2024. So now she can start claiming the $500 credit when she files her 2024 taxes. Then again, for 2 more years, as long as she continues to maintain the plan with the auto contribution feature. Whereas Brad doesn't have a plan, but he's eligible, right? He's a solo attorney with no employees. If he signs up here in 2024, he'd be able to claim the $500 tax credit when he files his 2024 taxes. And then again, for 2 more years, as long as he continues to maintain the plan with the auto contribution feature. All right. Thank you so much for listening. Thank you so much for the good comment. So I think you had to go, but yeah, please come back and please continue to engage. Like I said at the outset, we've got a tremendous schedule coming up. Please please subscribe so you get notifications for all of the webinars. You can access all the recordings. Okay, I think you got your comment. Thank you so much for the comment. We're going to go through these sequentially so we don't miss them. What is the difference between going with a third-party administrator who supports after-tax contributions and Mega versus going with mysolo401k.net? So, I mean, really, it just comes down to experience, all the service, right? It's some people have. There are companies that offer a solo 401k plan that might allow for the after-tax contributions, but they don't have the experience. They don't provide the service, right? In helping clients comply and meet all those technical requirements, like the separate accounts, preparing the 1099-R, which we handle as part of our service for no additional charge. So that would be a huge difference. Hopefully that helps. Thank you. Are Roth 401ks eligible for matching contributions from my employer? So great question. So matching contributions don't apply to any type of solo 401k. Those apply to employer plans, like a day job plan. So instead, with the solo 401k, you're able to make employer contributions. And the great thing about making employer contributions, or specifically non-elective or profit-sharing contributions, that there's no matching requirement, right? With the matching contribution, as the name implies, there's first an employee contribution made by the employee that's matched by the employer, right? With the solo 401k, many of our clients, they have a day job plan where they've maxed out their contributions to their day job plan, meaning they're not eligible to make any employee contributions to the solo 401k. But with the non-elective profit-sharing employer contribution, there's no prerequisite that that employee contributions were made to the solo 401k. So it's subject to the limits, et cetera, that individual would be able to make the full employer contribution to the solo 401k. So that's a difference, and that's, that confirms that one cannot make matching contributions to the solo 401k, but you can make profit sharing or non-elective. And we hope that helps. Thank you so much for the good question. So I currently have an S-Corp and I am the owner, no employees, just myself as a contractor. I'm looking to do the solo 401k. What do I need to do before calling you? Do not have payroll set up. So what you need to have earned self-employment income. So W-2 wages from your business taxes and S-Corp. That would establish that you're eligible to set up the solo 401k. And then that would be the basis on which you would make contributions to the plan, right? Because you can't save more than you earn. So what your earned self-employment compensation is W-2 wages. In the case of a business's taxed as an S corporation. Thank you so much for the good question. Hopefully that helps. What are some 401k administrative requirements that trip up first-time solo 401k individuals? I would just say not communicating, right? In terms of our experience, right? Like, we don't have access to any of our customers' accounts. We're very hands-on in helping them set up accounts at the bank or brokerage of choice. But we don't know, right, if someone is taking a distribution or if they're moving money from their after-tax to the Roth, if they want to take a 401k loan. I mean, we're very hands-on. We provide all the support that's needed for the plan, right? We would prepare the loan documents. We would handle the 1099-R, for that after-tax to Roth transfer. And we make it super easy. Like, we talked about how we have an online forms that you can use 24/7 to provide us that information. But that could be some good examples of where folks might get tripped up. Hopefully that helps. Is the income based on the amount that I pay myself as the solo W-2 earner? If I pay myself a salary, but the S-Corp at a loss for the year, do I still qualify? Yes, so it's based on the earned self-employment compensation, which is the W-2 wages from the self-employed business taxes and S-Corp. So even if overall that S-Corp is losing money, if you have those W-2 wages to justify the contribution, then those solo 401k contributions can be made based on that amount. So again, for a business that is taxed as an S-Corp or a C-Corp, we're going to have a whole series of these deep dive sessions for other business types. So please subscribe to get notifications. But for an S-Corp or a C-Corp, the self-employment compensation is equal to the W-2 wages that you receive from the S-Corp or the C-Corp. Specifically, box 1 of the W-2, plus any pre-tax elected deferrals not in box 1, but instead reported over in box 12. What deadlines must my business calendar will I need to submit regarding employer contributions to my solo? So it's going to be the business tax return deadline, including any timely filed extension. That's the contribution deadline. Great questions. Thank you so much for all the great questions. Please continue to feel free to ask questions. All right, for 2023, I have a day job. I maxed out my employee contributions, and my employer match was $10,000. I have $50,000 of self-employment income. So let's assume, we're talking about S-Corps and C-Corps here. So let's assume you have $50,000 of W-2. So you could make 100% of your self-employment income, $50,000 of W-2 in our assumption here, as a voluntary after-tax contribution. It is not reduced by employee contributions that are made to another plan sponsored by an unrelated employer, like a day job plan, whether it's employee contributions or even the employer match. So the individual would still be able to make the full $50,000 as an after-tax to the solo 401k. Thank you so much for the great questions. Is there a difference between making a Roth contributions and after-tax and then converting the same day? Well, yes, there's definitely a difference, because you have to put the voluntary, first of all, the voluntary after-tax contribution limit is higher. Voluntary after-tax contributions have to go into the separate voluntary after-tax account before they get moved over to the Roth account. Voluntary after-tax contributions are not reportable, but the subsequent transfer from the after-tax solo 401k sub-account to the Roth solo 401k sub-account is reportable on a 1099-R. Yes, it's totally acceptable to make 100% as a voluntary after-tax contribution, subject to the limits, right? You have to have the income to justify it as well, and then move that money to the Roth solo 401k account. No, someone could choose to not make employee contributions, could choose to not make employer contributions, and just make 100% of their contributions as voluntary after-tax contributions. So the eligibility requirement is that you have to be self-employed with no full-time, non-owner, non-spouse employees. So technically, there's no minimum amount of earned self-employment income that you need to be able to set up a solo 401k. Now, it needs to be a legitimate business. It couldn't just be like a hobby business where there's never any objective to make money, right? It needs to be a venture that has the objective of making money, but there's no requirement that the business be profitable, say in a particular year. So yes, it would be acceptable as long as you're reporting that self-employment activity, right? For example, on Schedule C. Now that means that you wouldn't be able to make, if there's no positive earned income, then there would be nothing to contribute to the solo 401k, right? Because you can't save more than you earn. So this individual might be able to set up a solo 401k, roll over money from, say, a former employer plan, but may not be able to make any contributions for that particular year. Hopefully that makes sense. Please explain again the employer contributions, max contributions. So the ability to contribute to the plan is based on the self-employment income, W-2 wages in the case of a business is taxed as an S-Corp or a C-Corp. Then it's going to be, for employer contributions, it's going to be a percentage of the self-employment compensation, specifically 25% of the W-2 wages. Now, the employer contribution is not impacted by contributions made. That limit is not reduced by contributions made to another plan by an unrelated employer like the day job plan, unless it's contributions that are made to a 403B plan. And then, of course, you've got to consider the overall limit to the solo 401k. So the sum of any employee, any after-tax, plus the employer contributions that you want to make cannot exceed the overall limit. I'm interested in the self-directed solo 401k. I have an LLC that I started a few years ago. I'm planning on opening. So ultimately, one does not need to have a formal legal entity to set up a solo 401k. What's most important is that they're reporting earned self-employment activity with no full-time, non-owner, non-spouse W-2 employees working for any business owned by that person or a spouse, if any. So it could be a sole proprietor, it could be an LLC, it could be an S-Corp, it could be an LLC taxed as an S-Corp, etc., that is the sponsor of the solo 401k. So if ultimately what's more important is the substance, right? Is the person actually self-employed? If they're operating their business through an LLC, then that's the entity that would be listed in our application. So it could be listed on the plan documents. Hopefully that makes sense. No, you can only use the earned self-employment income, the W-2 wages. For example, in the case of a business's taxed as an S-Corp, that one receives from their business taxed as an S-Corp. One cannot use W-2 wages from a day job to justify contributions, right? If they have $10,000 of W-2 wages from their S-Corp, that's the most that they contribute to the solo 401k. Even if they have a day job that pays them $100,000, they can't use those W-2 wages from their day job to justify solo 401k contributions. If someone is making $60,000 W-2 salary on an S-Corp and want to contribute $15,000 to profit sharing, the maximum after-tax contribution allowed is going to be the less. So the most that you can contribute 25% of the W-2 wages as an employer contribution, $15,000. Then you can contribute 100% of your W-2 wages up to the overall limit as an after-tax, but reduced by any other contributions made to the solo 401k, like the $15,000 employer. So the sum of the contributions, the employer, the after-tax, plus any employee, if any were made, cannot exceed the lesser of the self-employment compensation, the W-2 wages, or the overall limit, right? Because you can't save more than you earn. So it'd be $45,000 in your example. Can my solo 401k hold an option on the property, and concurrently, can I personally lend on the same property? No, you cannot do that. You can't personally benefit from your solo 401k investment. Good question. Regarding or otherwise be indirectly involved with that investment. Regarding the question above, the S-Corp profit is $100,000. It doesn't matter. You can only use the W-2 wages, not the owner income, to justify contributions to the solo 401k. So a lot of the concepts applies, but there are differences. So if your business is taxed as a sole proprietorship, like a single member LLC, please come back. Please subscribe so you can get notifications, because we're going to be hosting that webinar soon and going through these concepts as they apply to that type of business. It can be, you want to use the word trust plus two initial words, right? It could be some derivative of the business name, like if it's Smith Engineering LLC, it could be Smith Engineering Trust, but it doesn't have to be, right? It could be something totally different, right? It could be the street that you grew up on plus your favorite color, right? So Blue Roosevelt Trust or something like that. Are accounts open through my solo 401k at Schwab retirement trust accounts? And I currently use it. We have to open 3. So at Schwab, they call them company retirement accounts or CRA accounts. Generically speaking, they're called non-prototype accounts or investment-only accounts. Really, this is just fancy language for a brokerage account that's provided by Schwab in this case, but that's governed by a third-party plan. So it's helpful to remember that a 401k plan is really a legal entity. It's a trust. So like any legal entity, it's the documents that create it. So we are an IRS-approved 401k plan provider. So we would use our documents to create a plan specifically for the specific business. And then the accounts, though, can be somewhere else, like at Schwab, like a CRA account, where Schwab is providing the account, but it's, again, governed by that third-party plan. So this is why, even though Schwab offers their own solo 401k that doesn't allow for mega backdoor Roth, doesn't support the auto contribution tax credit, you can still have your account there at Schwab, because ultimately it's our document that's governing that account that does allow for the mega backdoor Roth, that does support the tax credit. Hopefully that makes sense. Thank you so much for the good question. Can you put the after-tax contributions into a solo 401k after-tax bank account, or does it have to go to a brokerage? It just has to go into a separate account opened up under the name and the EIN number of the plan. It could be a bank account or it could be a brokerage account. Yes, thank you so much regarding the audio. I think we just lost it for a minute there. If I set up a plan in Q4 2023, so it depends on when you set it up. So email us at business@mysolo401k.net and include the name of your plan in the subject line and we can verify. Thank you so much. Yes, if you took a solo 401k loan, even if you're age 65, you're obligated to pay back that loan according to the payment schedule. That's a great question, but that's a question for your business tax advisor. Thank you so much for the great feedback. Appreciate it. Purchasing property through the plan. The property would hold title in the name of the plan and tax filing under its own tax ID. Yes, the accounts, investments are opened up under the name and EIN number of the plan. We obtain an EIN number specifically for the plan as part of the onboarding process so that the IRS understands that this EIN number is associated with a 401k. So for example, if there's income that's being reported with respect to that EIN number, they're not looking for that income to be reported on the business tax return. Hopefully that makes sense. Yes, all of the contributions that one makes to the solo, so not the day job. In your example, you include day job. So only the employee contributions made to the solo 401k, only the employer contributions made to the solo 401k, only the voluntary after-tax contributions made to the solo 401k can't exceed the overall limit because that overall limit applies at the plan level. No, had a solo 401k, we rolled less than, I still need to file, will I work? Yes, because there's more than 12 months have passed. You have the successor plan rule. When someone shuts down a solo 401k and rolls the assets out of the plan, even to another retirement account, you have to wait 12 months before they can open up a new plan. So yes, you can certainly transfer over a former employer funds in a former employer plan, pre-tax funds in an IRA, like a SEP IRA. SEP IRAs now allow for Roth IRA contributions, but many don't have any Roth IRA funds in them yet. An existing solo 401k, now that would need to be done as a restatement. So it wouldn't be shutting down that plan and starting up a new plan. The existing plan would be restated to our plan. And that those funds would need to be transferred over. The money that's in the former employer plan and the SEP IRA could be transferred over, but doesn't have to be. So you can opt out of the default amount, and that allows you to make contributions of whichever amount or interval or schedule you prefer. Employer contributions do not have to be made in the same percentage or amount for each participant, like if there's multiple participants in the same solo 401k. Right, you do not have to reduce your ability to make voluntary after-tax contributions by employee contributions made to a day job 401k. So ultimately, you're going to be able to contribute more than $66,000 potentially to different retirement accounts, as long as you've got that self-employment income to justify the full $66,000. If you make a voluntary after-tax contribution for the prior calendar year, how do you indicate the transaction was for the prior year? Do you report an after-tax contribution? So voluntary after-tax contributions are they're not required to be reported, right? It's per those W-2 instructions, it's optional. The subsequent transfer would be reported, the subsequent transfer to either the Roth Solo 401k or Roth IRA, but it would be reported for the year of the conversion. So let's say someone made a 2023 after-tax contribution during the 2024 calendar year, then made a 2024 voluntary after-tax contribution during the 2024 calendar year, converted both buckets of funds to say a Roth Solo 401k during 2024, all of those amounts, so the contributions that were made for 2023 and the contributions that are made for 2024, will be reported on one 1099-R for 2024. So hopefully that helps and makes sense. So we're going to have, so please subscribe, because we're going to have a deep dive session specifically geared towards sole proprietors, single member LLCs. So one thing that we'll talk about there is that self-employment compensation for that type of business is equal to the net income reported on line 31 of Schedule C, less 1/2 of the self-employment tax. So you have to do a pre-calculation to determine your self-employment compensation. So of that amount, so it's going to be less than 50, right? If line 31 is of Schedule C is 50,000, because you have to reduce it by 1/2 of the self-employment tax. So of that amount, though, you're able to contribute 100% up to the overall limit, dollar for dollar, as a voluntary after-tax contribution. So let's say the amount was 48,000, just to pick a round number. You can contribute 100% up to 48,000 as a voluntary after-tax, and it's not reduced by the employee contributions made to the day job plan. That voluntary after-tax contribution limit is determined at the plan level. It's not reduced by contributions made to a day job plan. We've got that slide here where it talks about that. Hopefully that makes sense. Please email us at business@mysolo401k.net and include the name of your plan in the subject line so we can determine. We handle the 1099-R as an optional free service for our clients. We have a form on our website that clients use to let us know the information that's needed to be able to prepare the 1099-R. Hopefully that makes sense. So thank you so much for all the great participation. We certainly appreciate it. We have a great series of content coming up. Please like and subscribe so you can get access to all the content. We host daily webinars on our community, Zooms, I should say, more like office hours, at mysolo401k.net/my community, 1 p.m. Pacific, 4 p.m. Eastern. It's always free to join. All are welcome. You can post questions 24/7 in our forums. We have webinars and videos libraries on our community as well. We've got hundreds of videos and webinars in there. So there's a lot of great content, lots of ways to learn, to engage, to hear what other people are asking, which is always a great way to learn as well. So like I said, subscribe for access to the upcoming webinars. You got more of these deep dive contribution sessions focused on sole proprietors, single member LLCs, partnerships, multi-member LLCs, the mega backdoor Roth scenarios. We're also going to talk about how much income do I need. So, the magic number, right, of income that you need in order to be able to maximize contributions for, again, all the different scenarios, whether it's an S or a C, a sole proprietor, or a multi-member LLC, like a partnership. So please, thank you so much. So all the best, everyone. Thank you so much for all the great participation. We really do appreciate it. Take care.